Welcome back to the channel where we break down all things finance without putting you to sleep. Today we're talking about something that might sound boring at first, but trust me, it's the backbone of how governments and companies make things happen. Bonds. Yeah, not just the spy kind like Jay's bond, although if you stick around you'll definitely feel like a financial secret agent. Let's dive in. Alright, so what exactly is a bond? Well, imagine you lend money to your friend to help them start a lemonade stand. In return, they promise to pay you back, plus interest, like maybe an extra free lemonade every month. A bond works the same way. When you buy a bond, you're lending money to the government or companies, and they promise to pay you back with interest over time. So why the governments or companies issue bonds? Well, because they need cash for projects. Like governments might need to build roads and companies might want to launch the next cool gadget. They don't have that much money lying around, so they ask for your help. And hey, you get paid back for it. Win-win, right? Okay, quick history lesson. Don't worry, I'll keep it short. Bonds go way back, like ancient times back. Medieval Venice used bonds to fund wars, and in the 1600s, the Dutch kicked off the modern bond market. Fast forward to the US Revolution and boom, the US was using bonds to fund the war. Basically, bonds have been around forever because, well, people always need money and lending it works. Here's how it works in a nutshell. You, the awesome investor, buy a bond. The government or company, the borrower, pays you interest. This is called the coupon, but no, it's not for shopping. After a set period, they give you back what you paid, the principal. Simple, right? It's like the most predictable deal ever, unlike the stock market where things can get wild. Bonds are considered safer than stocks because you know exactly how much you'll get and when. It's like that one friend who always pays you back on time. Now let's dive into the types of bonds, because of course there are a ton of options, but don't worry, we'll break them down. These are like the ultimate safety net because, hey, it's backed by the government. You're basically lending Uncle Sam some cash and he's promising to pay you back with interest. Example, US Treasury bonds. It's like handing money to the US government and saying, hey, don't spend it all in one place. Oh wait, that's exactly what they're gonna do. Companies issue these to raise money for all sorts of things. New products, expansions, maybe even that futuristic coffee machine no one asked for. Example, Apple bonds. You lend them money, they pay you back with the interest, and maybe one day your money will help fund the iPhone 47. Local governments issue these to fund things like schools, hospitals, and parks. The cool thing, the interest is often tax-free. Example, Los Angeles might issue a bond to build a library, and you're helping them to do it. So yeah, you're pretty much a community hero. These are bonds for the patient people. They don't pay interest regularly. Instead, you buy them at a discount and wait to cash in big later. Example, buy a bond for $750, wait 10 years and boom, it works. $1,000. It's like time traveling money. These are like the secret agents of the bond world. They start as regular bonds, but you can convert them into company stock if things go well. Example, Tesla convertible bonds. Get your interest, and if Tesla stock is booming, you can swap your bond for shares. It's a two-in-one deal. These are bonds that can be called back early by the issuer if they want to refinance at a lower rate. Basically, they pay you back early to save themselves some cash. Example, Verizon issues a 10-year bond, but if interest rates drop after 5 years, they might say, hey, here's your money back, thanks for your loan. Inflation-linked bonds protecting you from rising prices by adjusting with inflation. Example, U.S. Treasury Inflation Protected Securities (TIPS). If inflation goes up, so does your bond value, so your money doesn't lose its buying power. Fancy, right? These are risky bonds from companies with lower credit ratings. They pay you more interest but carry more risk. Example, XYZ Electronics issues high-yield bonds because they don't have a great credit score. High risk, high reward, just don't be surprised if they ghost you. Green bonds are for saving the planet while making some cash. They finance eco-friendly projects like renewable energy. Example, the World Bank issues green bonds to fund wind farms and solar energy. You're helping the earth and learning the interest. That's a win-win. So there you have it, bonds in a nutshell. They're loans you give out, but with the benefit of getting paid back with interest. They can be safe, risky, or even eco-friendly. There's something for everyone. If you found this helpful or at least mildly entertaining, smash that like button and subscribe for more fun financial breakdowns. Got questions about bonds or want to know more about investing? Drop them in the comments below and I'll be happy to help. Catch you in the next video. Until then, stay financially savvy.